Very few people are prepared for the destruction coming to their investment portfolios if they're heavily allocated to bonds. Regardless of political candidate, the best investors in the world and the bond market itself are preparing for high inflation. Today, we'll show you why the world is shifting away from bonds and why you should consider adding Bitcoin to your portfolio in its place. Strap in. We're going to get nerdy on this one. What's up, everybody? I'm Dante Cook with Bitcoin Simply, where I help you to understand macro and markets in a simple way. Subscribe to the channel if you already haven't. We create content 6 days a week, and today we're going to be doing some live simulations to compare bonds to Bitcoin and why you should consider adding Bitcoin to your portfolio as we move into a high inflation environment. Let's go. The bond market is the $130 trillion market tail that wags the dog. For the past 40 years, the U.S. sovereign long-term bonds have been the safe haven investment for people's personal portfolios and sovereign nations themselves. Stocks and bonds used to compete with each other before we were in a permanent money printing environment. And that's why the 60-40 portfolio was born in the first place. While stocks outperformed, bonds would provide a steady return. And when stocks underperformed, bonds would provide a steady return. But now, when you look at any 7-year rolling period, bonds return just 1.5% to stocks 14.5% in any given 60-40 portfolio. And this is largely because we now have a debt problem and an inflation problem as a result. Let's go to the debt problem first. We are absolutely drunk on debt. The federal debt jumped $31 billion just yesterday, up $384 billion this month, and we're fast approaching $36 billion in debt in the United States. And in order to fund these deficits, we have to raise more and more money through bonds, meaning we need other people to invest in our debt problem. The knock-on effect of being in a long-term monetary or fiscal dominant position is that we have long-term inflation, and it's entrenched at this point. And despite what the government says, people actually feel it. If you look at this chart from Jim Bianco, you can see that we haven't returned to the same inflation levels that we did pre-COVID. Not only is there more volatility, but the number is higher by almost double on average. So the result is people who are investing in bonds are getting a return, but they're becoming poor as a result. Over the last 30 years, the return of bonds when measured against inflation are actually negative. After the last Fed cut in September, the market believes that inflation is going higher. So what the market is saying in plain English is that you have to pay me more for me to give you money because I don't trust you, and I believe that inflation is going much higher from here. One of the greatest investors in all time, Stanley Druckenmiller, is making a large bet that bonds are going much higher from here. He's betting that there's a possibility that we see inflation like we saw in the 1970s, above 10%. So if we go back to that world with 10% plus inflation, that means if you get a nominal return of 5%, you're getting poor at 5% a year, which spells doom for many people looking to retire. So in today's episode, I wanted to nerd out together. I wanted to run a few simulations and show you why even the data says that you should invest into Bitcoin versus bonds in your portfolio, especially if we're moving into a high inflation environment. But before I get into it, let's look at this great memo from Matt Hogan, CIO of Bitwise. He makes the case by using data that says that by just adding a little bit of Bitcoin to a traditional 60-40 portfolio, the returns are massive. According to his backtesting, a 2.5% allocation to Bitcoin in a traditional 60-40 portfolio would have boosted returns from 98% to 148%. And all of this is while the volatility or the max drawdowns wouldn't have changed very much. A 5% allocation to Bitcoin increased returns by over 100% over a 10-year period. But let's look into a couple scenarios together where we actually dive into what the numbers say based on what we believe expected returns for both bonds and Bitcoin will be moving into the future. So let me share my screen. So for those of you who aren't data nerds like me, what we're looking at is a Monte Carlo simulation. And what these sorts of simulations and models do is they look to try to help us understand a range of outcomes that we can have in uncertain environments. So it'll run a bunch of scenarios or simulations based on past returns to determine what could happen in the future. And there's a couple things that we want to look at here on the screen that are really important. So the asset class that I'm looking at is TLT, which is the 20-year Treasury or long-term Treasury note for the United States government. And so the amount of time that I wanted to simulate was roughly 5 years. And the number of simulations that I wanted it to do were 1,000 simulations. And here is what we find. What we find is 95% of the values that we get are between $54 and $275, and the starting value is 92. And the probability of us having a positive return is 75%. But what are those kinds of returns that we're looking to get in this time period? Well, we're looking at an annualized or average return of roughly 4% a year based on historical performance going back to 2002. And this is all with a volatility of 14.5%. So this means that 75% of the time we're going to get a positive return, and a positive return on average of 4%. So we're going to win most likely, but when we're looking at an inflationary environment that base case over the next 5 years, we believe will be at or more than 4%, then that means we're statistically guaranteed to get poor over time. Now, I want to take the same simulation and compare Bitcoin and see what we get and what the types of return profiles that come out of a Monte Carlo simulation. We're running the same simulation on Bitcoin as an asset class, and here's what we get. Based upon historical data going back to 2014, the range of outcomes that we see, 95% of the final values across these 1,000 simulations come at between $33,000 and $14 million. Here's the most interesting thing, because some people get caught up in the range of outcomes that they could get, which from here, that means that you're likely to lose about 60 to 70% of your value over time. But if things go like this simulation is predicting, well, then it believes that you're going to have the opportunity to have $14 million per coin in just 5 years, the same time frame that we looked at for bonds. But here's the most important part. Based upon historical returns, it's saying that you have an almost 94% or 93.4% chance of having positive returns. And although there's a volatility of 70%, your annualized average return is 62%. So would you take a 15x return for just 3.5 times more volatility? That's the type of math that you should be thinking about when looking at adding Bitcoin versus bonds into your portfolio. That's why institutions like Florida State and their CFO are talking about adding Bitcoin to their state pension fund. And speaking of being a fiduciary and protecting your investment, if you're not taking self-custody of your Bitcoin, you're leaving it on exchanges and outsourcing responsibility to other people, well, then you're not fully protecting your asset. And I suggest that you talk to the team at thebitcoinway.com. They will give you a one-on-one expert and coach to help guide you through self-custody, taking control of your private keys, and securing your generational wealth. Schedule a free meeting with their team today at thebitcoinway.com. Let's go back to Matt Hogan, CIO of Bitwise, who says that this is just the beginning of institutions pouring into Bitcoin, like Florida State's pension fund. Because of institutions pouring into Bitcoin, Bitcoin is up 18% in October, just like we predicted. And regardless of who gets voted into office, Bitcoin is shaping up to have a wild and crazy November. A November to remember. November should present long-term investors many opportunities to consider shifting away from bonds in a high inflation environment to something like Bitcoin, which is going to protect your purchasing power above the rate of inflation moving forward. And with that, thanks for nerding out with me today. This is Dante Cook with Bitcoin Simply. Happy stacking.